This Wednesday, we're going to be talking about how to pay off your mortgage using the cash value of a life insurance policy. Wow. When I discovered this, it blew my mind. And now that I'm applying it for myself, I see the equity in my policy growing, and I'm excited about never stopping the forward growth of my money. One of the biggest causes of financial failure is consistently taking your cash down to the line of zero. Did you know that cash is the lowest form of compensation? Yes, cash is the lowest form of compensation. Richelle, why do you say that? Inflation. A dollar in 1992 purchased more products than a dollar does in the year 2025. You understand what I'm saying? So a dollar during the course of time loses value if it's not growing by 5% interest or more. So when you set cash and it doesn't grow, the value of your cash goes down. It decreases each and every year. So cash is the lowest form of compensation. Now you think about something that's the lowest form of compensation, and now you're taking and you're spending your bank account down to the line of zero. So you're using the lowest form of compensation and you're constantly taking it down to the line of zero. What does that mean? That spells struggle. That spells living paycheck to paycheck. No matter how much cash you get, if you spend it all up down to the line of zero, you're going to be in the rat race, always trying to catch up. The highest form of compensation is leverage. What? Wealthy people, wealthy minded people, such as myself, we don't use our own cash. Wealthy people are always looking for a way to leverage cash. Now, what does that mean? Does that mean I do something ungodly, like I take your money to pay my bills and give you nothing in return? Absolutely not. That means value for value. So that means if I borrow $100,000 from the bank, I'm paying them back 5% interest or whatever interest they're asking for. But I take that $100,000 and I make $200,000 with it. So I pay the bank back their $105,000 and I pocket $195,000 as my profit. That is being your own bank, exchanging value for cheap money. Oh, I said so much just there. Somebody, if you really understood what I just said, you would be sending me a cash app right now, which means taking cheap money, cheap loans, leveraging them to make more money. Wealthy people live off leverage because if you're living off leverage, you're never taking your cash down to the line of zero. Such is being your own bank. Wow! I am giving up so much right now. So many gems, so many treasures. I hope you caught that. So, if you have a mind to at least learn leverage, you can be wealthy and never take your cash down to the line of zero. But it starts with a mind to leverage. Leveraging also means you know you are a tech genius and I am a life insurance genius. We get together and build $1 billion business. That's leverage. You're leveraging my skills, I'm leveraging your skills. We get together and build $1 billion business. Leveraging is a mindset that can be applied to almost anything that has value. You can leverage a pet. Your pet's giving you love, companionship, listening to you, and your pet's leveraging you. You're feeding your pet, sheltering your pet, loving on your pet. That's leverage. Relationship leveraging, right? Leveraging your bank account. Instead of spending your money down to the line of zero, going in and telling the banker, listen, I've got $100,000 in cash in the bank. I want to use that cash as collateral for a $200,000 loan. And if I don't pay you back, you can take all of my $100,000 and I'll pay you back the rest quarterly, annually, monthly, plus 5% interest, right? So you just leveraged your cash for $200,000, right? Leveraging the equity in your home. You have equity in your home. Did you know that you could use it to write checks? Oh, wow. You could leverage the equity in your home. Leveraging is a mindset, right? My mom and my son and me, we live in the same home together. We leverage each other. My mom helps out and does this and that. I do this and that, and my son does this and that. And we have a leveraging relationship. Financial leveraging, relationship leveraging. We're leveraging. Leveraging is a principle of multiplying everything you have. The Bible says a three-strand cord cannot be easily broken. You plus one other person who's in complete harmony with you, plus the Holy Spirit, infinite intelligence, God, wrapped around each other, that three-strand cord cannot be broken. It is leveraging. Yep. When you read the Bible, you are leveraging God's word, filling your spirit. And when God speaks back to you through an unction, he's leveraging you. He's telling you to go talk to that person. He's telling you to go here, there, and do this and that. And you're listening and fulfilling his plan here on earth. Leveraging. Right? So leveraging with money is no different. How can I take my dollar and use it to make more dollars? How can I take my dollar and say, "Hey, give me this much and I'll give you that much back." Right? Borrowing money to make more money, to multiply your life, and making sure you're paying back the lender what they asked. Leveraging, right? So leveraging is a mindset. And we start there when you're talking about being your own bank, because banks are the masters of leveraging. A bank opens up, it has $0. Did you think a bank started and they have a bunch of money of their own? No. Banks have no money of their own. Banks make money when we deposit money into the bank. So I go into the bank, I deposit $100,000 and I let it sit there. And Miss Sally comes in and she wants a $50,000 loan. Miss Sally, they say, what's your credit score? She says, oh, it's about just under 700. So they'll charge Miss Sally 15% interest for a $50,000 loan. When Miss Sally pays back that 15% interest, that's where the bank makes a profit. So the bank makes money using my money. So the bank will take my $50,000 out, loan it to her, charge her 15% interest, and voila. So the bank is just shuffling money from one account into loans. So the bank is not in the business of denying loans. They just want to make sure that you're credit worthy. Do you pay them back? Can you pay them back? As long as you can pay them back, they're making money. Does that make sense? That's leveraging. All right. So how are we doing? It's about 7:59, and at 8 o'clock, I'm going to hit record and we are going to start this lesson. Today's lesson is how to take the cash value of a life insurance policy and use it to pay off your mortgage. Wow, I love this subject. I'm so full, I can't help myself. I've got to talk. All right, so I'm going to give myself a few more hearts. I'm going to hit record and we are going to get started. All right, let's go. How do you use the cash value of a life insurance policy to pay off your mortgage? And why would you want to use the cash value of a life insurance policy to pay off your mortgage or to pay off anything? Isn't it true that if you borrow from a life insurance policy, you're decreasing your death benefit and taking your account down to the line of zero? Does that mean you're going to leave your family less money because you borrowed from a life insurance policy? Well, my grandma told me never to borrow from a life insurance policy because life insurance is just for death. And you're doing it so that your family's not GoFunding you. So why would you take your money out of your death benefit to pay for your mortgage? Isn't that selfish? These are the questions that ran through my head when I first came into the insurance business. My grandmother had a life insurance policy and she paid it for 40 years. The insurance man came around and knocked on the door, collected the premiums, and my grandmother paid it faithfully. My grandmother borrowed from her life insurance somewhere around age 70. And when she passed away, her life insurance only paid out $3,500. And in 2000, I want to say 8, when she passed away, it was not enough money to bury her. We ended up having to pass the plate. My uncles came up with money. My mom, my family, we had to come up with money, and we had to find an inexpensive place to bury my grandmother. Maybe about 7 years after she passed, my uncles gathered money together and they put a headstone on her grave. It was behind a little small church down in Waldorf, Maryland. I'll never forget. So my grandmother would say, why would you borrow money from your life insurance? You're just taking your family to the poorhouse. They have to come up with money to bury you and to bury you. That's a shame on the family and the family legacy, right? So my grandma Belle would say, why are you teaching people to borrow out of their death benefit and leave their family in a unhealthy place? I even had a pastor come on one time and he told me, Richelle, I had to borrow money from my 401k to bury my mama. And my brother and I got into a fight because he wouldn't put any money towards our mama's burial. So there are a lot of horror stories about this. But I want to tell you right now today, if you cannot borrow money from your life insurance without decreasing the death benefit, you have the wrong type of life insurance. You have something called a final expense policy. You cannot borrow money from a final expense policy without decreasing the death benefit. There's only a certain type of life insurance that will allow you to do this. And if you don't have that type of life insurance, this advice is not for you. Well, what kind of life insurance do you need? You need something called a dividend paying whole life policy or an index universal life policy where the agent has taken commission cuts and allowed you to get plenty of cash value in the policy. If you don't have a properly structured index universal life insurance policy, this advice is not for you. You must have a high dividend paying whole life policy with paid up additions. And the paid up additions have to be reinvested in the policy so that it grows exponentially. And if your agent has no idea what I just said, you've got the wrong agent and you've got the wrong policy, and this be your own bank concept does not apply to you. In order to execute the concept that I'm telling you, there have to be a few things in place. You need to be in a financial position to overfund the life insurance, which means we minimize the death benefit and max out the cash, and you're able to put excess money in it. Number one, you have to be able to put excess money in it. Number two is you need to have an agent that's willing to take commission cuts, willing and able. If the agent can't take commission cuts because they are employed by an agency that won't allow them to do that, you won't be able to be your own bank, right? Or if the agent is just simply unwilling, they could do it, but they're unwilling to take commission cuts, then you won't be able to do it. I heard a quote by Barry Gordy the other day. He said, "It is hard to get a person to see your point of view when their point of view is paying the bills. Even if their point of view is a lie, it's hard to get a person, convince a person of the truth when a lie is paying their bills." Again, it's hard to get a person to believe the truth when a lie is paying their bills. So if you have an agent who's getting their bills paid by selling you more death benefit, you're not going to be able to be your own bank using this type of policy. And then you're going to listen to Dave Ramsey and Susie Orman and different people tell you that whole life is trash, and they're right. That whole life can be trash if you're not sick. If you're sick, if you have health challenges, and it's hard to get coverage, that whole life policy is your saving grace. You need that final expense policy to make sure that your children and your family are taken care of, right? So number one, you have to be financially fit so that you can overfund the policy. That's number one. Number two, you have to have an agent, an agency, or broker that's willing and able to take commission cuts to get you additional cash in the policy. Number three, you have to be in decent health. Now, I'm not talking about high blood, diabetes, and slightly overweight. The majority of the population of the United States falls into that category. I'm talking about you have a critical or a chronic illness, cancer, heart attack, heart disease, stroke, kidney disease. You were hospitalized or about to be hospitalized within the past 5 to 10 years. The life insurance is going to be too expensive for you to overfund to be your own bank. The death benefit's going to eat up the cash. So you won't be able to be your own bank if you have serious health challenges. So number one, you have to be able to overfund the policy. Number two, you have to have the right agent or broker who's willing to take commission cuts on your behalf. Number three, you have to be in standard. If it's just slightly substandard health, that's okay, but you have to be standard to excellent health so that we can get the cost of life insurance down, so we can get your cash value up. Picking up what I'm laying down. So if you fall into this category, then this program that you're watching is for you. You qualify. I guess the other thing I'd have to add to that is you need to be 75 years old or younger. Yeah, you could actually do this on a teenager. You can't really be your own bank on a child that's elementary school age, because the life insurance company is funny about putting large amounts of life insurance on children. There's strict laws about that, right? But if you have a child that's 18 or 20 or 22 years old and your health doesn't qualify, you could use their age and their relationship with you to be your own bank. So you could actually do what? Leverage a family member that's a little younger and in good health. I have a client, she's just about 80 years old, and she's been using her grandchild's policy to be her own bank. She's paid off her mortgage. She's done all kinds of wonderful things using this concept. And she's one of my favorite clients. So, yes, you can leverage somebody else who's a child or a grandchild or a spouse. Can you leverage a brother or sister? No. Okay. It has to be an immediate family member. All right. All right. So, we've laid down all those different things. Now, guess what? I'm going to give you a treat. I am going to show you one of my life insurance policies. Woo. Now, I have three policies. All right. And this is one of my policies I just took out on myself about 3 years ago. This is how I plan to pay off my mortgage. Let's take a look at Miss Richelle's policy. Woo, that sounds like, I like that. Okay. It's nothing like, if you have someone who's trying to teach you something, one of the first things you should do is turn around and look at that person and say, are you doing this? And if that person's not doing it, then you need to say, well, how are you going to teach me how to do it if you're not doing it for yourself, right? Are you doing this for yourself? Uh-oh, I'm signing in wrong. Wait a minute, let me stop sharing my screen. I was about to share too much with y'all. All right, so let me log in. Okay, I'm gonna log in. Y'all thought I was already logged in, but I timed out. So I've got to log back in. Y'all still with me? Sure, Miss Richelle. We're with you. We're with you. Okay, I'm almost logged in, y'all. Boom and boom. All right, so hold tight. So again, you need to be in a financial position to be able to overfund the policy. And I'm going to be honest with you, that starts at about $500 a month. Yes? Okay? So you need to be able to put in at least $500 a month under normal circumstances. Number two, you need to have an agent, which is me. You can stop right there because our firm does what? We exchange referrals instead of commissions from selling you a bunch of death benefit. So in exchange for referrals, we'll take big commission cuts and get you lots of cash in your policy. So you have stumbled across a rare, rare find when you stumbled across us. And then number three, you have to be in decent health. No cancer on your medical records, no critical or chronic illnesses on your medical records within the past 10 years. You can be a little chubby, you can have your high blood and your diabetes, and as long as you're taking pills, not insulin shots, but pills, right? And you can still qualify for this. All right, so I'm ready. All right, so here we go. Check it out. So just so you know that this is real and authentic, I am showing you my policy. That is right. Take a look at this. That says Richelle Dickerson, doesn't it? Mm-hmm. And this is an enforced illustration. So there you go. Okay. So what I am going to do is I started funding this policy about 3 years ago, and I started it at about $500 a month. And then I just started tithing to myself. I started tithing. So there's an app that you have on your phone, and you can put money in there just using your app. So what I did was I got myself up to $2,000 per month. All right. So, yes, you do need to, if you're 50, I'm 56. The older you are, the more you need to fund it. Okay. So, let's just take a look at this. This is me putting in $2,000 a month. So, that would mean there's what, 10 more months left in the year? Well, that would mean that I would end up putting in another $10,000 for the year. How much cash value would I have? Well, the company would take, I would end up putting in $10,000. And then on top of what I have in there, I would end up with $13,000 and some change. At the end of the year, I'd have $8,904. So, how do you use this cash value to be your own bank? Well, what I do is borrow the mortgage payment out of the cash value. Do you hear what I'm saying? So let's just say in this example, your mortgage is $1,000 a month. So what you do is you borrow $1,000 out of your cash value. Well, why would you do that, Richelle? Because borrowing the life insurance company's money means that the $13,197 is going to sit in there and it's going to continue to grow. You have 13 months to pay back the $1,000 plus 5% interest. That means you're going to pay them back $1,050. And you have until the end of the year to pay that money back. It's the cheapest loan you'll ever get. Now, during the course of this 12 months, you're going to see your account value grow. So, for example, next month, the account will go from $13,197 to $13,205. Then to $13,313. And every single month, that account is going to earn money babies. So the money babies, that account is pregnant with interest, and it's going to grow and grow and grow and grow, never stopping the forward momentum of your money. And it's going to get the opportunity to grow for one whole year. In the meantime, I pay back the $1,000 loan at my own pace, when I want to and how I want to. And if I don't pay back that loan, whatever the balance is would be decreased from my death benefit and my account value at the end of the year. So what am I doing? I'm leveraging the life insurance company's money to pay my mortgage. All right. So I use that to pay my mortgage, and take a look at what's happening. Next year I have $30,934. The year after that, I have $53,990, and then so on. And at age 60, I have $105,130. This is a tax-free money exchange. Why is that money tax-free? Because loans cannot be taxed. Death benefit payout cannot be taxed. So at the end of the year, you'd be surrendering a portion of your death benefit if you don't pay back your loan. And because you're giving up a part of your death benefit, the money is tax free. If you pay it all back, your death benefit stays intact and your money has gone on steroids. Are y'all with me? All right. So I could wait and just take out $100,000, pay off that mortgage, right? And never stop the forward growth of my money. If I don't pay them back and I'm okay with losing that in death benefit, then I'm okay. Then my death benefit will go down to $500,000, right? As long as I'm continuing to pay my premium, it's just like pulling the tail off of a lizard. It just grows right back again as long as I keep funding it. Does that make sense? So this is how I am using the policy to be my own bank. All right. Listen, if you have questions about how this is done and how to have a policy structure for you, reach out to me at Rhema, RHEMA, financial coaching at gmail.com. That's my email address. Or reach out to me at Rhema, RHEMA, financial solutions with an S dot net. Hit book a phone call. And then let's get on the phone for about 15 minutes and show you how to be your own bank. All right? Richelle Dickerson, signing off from Virginia Beach, Virginia. Love and blessings.